So last week, we saw that US labor market remained resilient and equity markets rallied on strong corporate earnings. Here, I'll be sharing market insights looking at what happened the previous week and the expectations for Euro, Gold, S&P 500, and oil. My name is Avinash Bojwani, and I'm here from my Market Bits channel. This is just my opinion and not a financial advice. So last week, there were three main releases which happened. One is the corporate earnings. So majorly, as of May 7th, about 85% of the stocks trading in S&P 500 reported its quarterly results. Within S&P 500, information technology led the way, lifted by boosted demand from the AI infrastructure and consumption. So mostly like 4 out of 7 magnificent stocks had announced its results, and majority of these stocks are positive. Even the S&P 500 is at all-time high. Second important data release was the NFP, Non Farm Payroll. The entire employment data, which was announced last week, starting from the ADP employment, jobless claims, and then the non farm payroll, along with the unemployment data, unemployment rate. So the most important figure is the NFP. So the US economy added 115,000 jobs versus the consensus, which was expected at 65,000 jobs. With the previous data was 185,000, which was revised from 178,000 jobs. So most job gains were in the healthcare, transportation, warehousing, and the retail side. Next comes the third important data was the Euro Producers Price Index. So Producer Price Index is the inflation data from the manufacturer's point of view. See, why PPI was important last week, because there was a much difference, because the previous figure, which was minus 0.6%, and the expectation came for this month, the consensus was 3.3%, and the data release came at 3.4%. So now European Central Bank are aiming or signaling for a rate increase in June, and currently interest rate stands at 2.15%. So this was the three main data which was last week. Coming at the current scenario for this upcoming week, on Monday we don't have much data coming. So Tuesday we have the CPI, which is the Consumer Price Index, which I already had shared in my Instagram channel. You can follow me at marketbits_Avinash in Insta, where I've explained about the CPI. So CPI is a Consumer Price Index, which is a measure of inflation, which tracks the changes in the prices of goods and services. Core CPI is the same, excluding the food and energy sector. So there is three data from the US, which is on Tuesday, which is core CPI, month-on-month, CPI month-on-month, CPI year-on-year. See, mostly when the figure, say for core CPI, the figure is 0.3%. So if the figure comes 0.4% on Tuesday, 4:30, and relatively if CPI comes 0.6, 0.7%, and the CPI year-on-year comes 3.8%, meaning above, then the forecast is good for the dollar. So it will come in green. If it's less than 0.3%, if it comes 0.2% or 0.1%, it will come in red, means it's in against the US dollar, against the currency. So higher data will be better for the currency. Along with that, there is the Fed chair nomination vote, which is already expected that Kevin Warsh would be heading or becoming the next Fed chairman after the exit of Jeremy Powell, which was nominated by the US President Donald Trump. On Wednesday, we have the core PPI and the PPI. So now PPI is similar to CPI, which is Consumer Price Index, but this is Producers Price Index. The Producers Price Index is the inflation from the manufacturer's point of view, like the raw materials, the cost, the manufacturing costs. So ultimately, it's passed to the consumers. So here as well, the same it will happen. So if the PPI, which is 0.5%, if it comes to say 0.7%, so this is relating to inflation, and if the figure is 0.7%, it will be in favor of the dollar. So there is room for US Federal Bank to increase the interest rate if the inflation is too high. Going back on Thursday, next day is the UK GDP, which is the gross domestic product, which measures the total output of goods and services produced in the country. So currently forecast is at minus 0.2%. So if the figure stays at minus 0.2 or 0.3 continuously, it can lead to recession. So currently we are just looking, if the figure is even say minus 0.1%, it is good for the pound. If the figure is say minus 0.5%, which is measuring against the forecast, will be bad for the GPP. Same day we have the retail sales. The core retail sales is the sales excluding the automobile sector. So retail sales is the total sales which is relates to the consumer spending. So if the overall consumer spending is high, retail sales will show positive, like 0.8, 0.9%, which is good for the economy. So that's about it for the fundamental side. Now we will go to the technical side. So technically, let's start with the euro. As we know that in June, they may be a signal of interest rate rise. Now, euro has been overall, like from say one and a half month, the euro has been going up slowly. But also from the past 4 months, the euro is totally, like, it's showing as a downtrend because it is the lower highs. The high was here, and then the next high was at around 1.1830. The next high, which was like below 1.18, and even it did not cross that. But you see that it is in a very crucial point. Even it's trying to break, and maybe it may open on Monday over this. Like, it can show you a breakout. But what we are seeing is, until if it doesn't hold above 1.1830, I would, be cautious. Even 1.1830 in last July, here consolidating many times. Only once it had gone down, but overall, even it had broken 1.1830. That was like 80 to 90 points up. So it may be a crucial point. So we may rather wait for 1.1830, or if it goes below 1.17, it's a good area where you can go for another 100 pips. So let's go with S&P 500 after that. S&P 500, what we've seen, of course, it's at record highs. All the indices, as I mentioned, because of two reasons: AI demand and the geopolitical tensions ease off with strong corporate earnings. That's led to strong upside. Now we've seen that here. I just put the Fibonacci with the previous highs connecting to the last lows, which was the lows. It already broke the 100%, which was the similar high, and now heading to 1.1618 level. Now, what does that mean? That means that it's at a very crucial point. I wouldn't see that it falling because it's at a very strong uptrend, but I may see some consolidation. So I've drawn a trend line, which can be that there can be some consolidation here. Testing it, it can break and try to bounce from here, or try to play from here, or try to break the upside. So currently there may be a 200, 300 points up or down. Not much to do after that. Looking at the crude oil, you see that all the charts we've discussed is daily chart because it's a better way to look at. So at the daily chart, even you see the crude oil earlier, there was a huge spike, there was a huge movement of around, roughly $50. And then the movement became like $45, and now it became like almost like $30. So you see that there has been a consolidation, and the the gaps are becoming smaller. Now currently you can see 105 levels and 90 levels. It is between that. So currently, it's a good point where you have a good margin. You can buy from the low and keep a stop loss below this, and then you can target somewhere here, unless until you get. So, but there are geopolitical tensions. So based on that, the market can move sideways either ways.